Sandeep Bhatia, MD Head of Equity India at Macquarie Securities Group as well joins in. Sandeep, hi, morning. We were just debating on the listing of IRB InvIT, whether or not the prospects of infrastructure as well as InvITs is bright. What is your own take on this?
Well, we don't have an official coverage on these InvITs, but my just quick brief take is that I think we are in a good phase as far as InvIT listing is concerned. In this phase, we see the initial phase, we see high quality assets come through and get listed, and these are the assets which find good demand, and therefore this is something which most of these assets have already stabilized, and so there's a proper pricing that can happen. Price discovery is easier. So I think in this phase there is definitely good prospects of InvITs. I think when this market broadens, develops, and it becomes it becomes routine, that's when some of the lower quality assets come into play, and that's when the risks come to the fore. We are at just the very initial phase, so I think we are all good and safe right now.
Talking about that, what really is the big talking point today, Sandeep, is the rest of the market and this global meltdown which seems to have taken place, and fears that there is going to be perhaps Trump's impeachment, and that's really bringing about a fair amount of nervousness across the Wall Street. How long lasting could this be, and do you think the market fears are true?
I think it's difficult to sit here in India and make comments and observations as an expert on US politics. I'll take a stab at it, but it's just could be very pedestrian. I think what is happening in India is the domestic economy is going to do better, and that is getting strengthened if there's political uncertainty outside India. Whether it is US or whether it's any country, the reality is that India's political stability, India's policy clarity, and India's domestic growth is coming to the fore. We have not been big buyers of the export-oriented sectors, especially IT and pharma. I think these sectors will continue to underperform. The focus has to be on domestic stories. The focus has to be on domestic consumption, domestic banks. And I would also say that the sectors will broaden as this rally proceeds through the rest of this year. We expect strong consumption to come through on the back of good monsoon. That will give an impetus to autos, that will give an impetus to motorcycles. But I think the investment cycle will also pick up. We have seen the first beginnings of that in the commentary and the analyst meet held by some of these companies such as Siemens and ABB India. And this will something which will take further strength through the rest of this year. So the domestic story is where to focus on, and what happens in the US is important, but the big story in India is India itself, and that's where we need to place our bets.
Sandeep, having said that, markets have already seen a very sharp vertical rise, 15-16% up on the index, 20% plus on the mid-cap index on back of a great 2016. So some would argue that earnings recovery may be coming, but markets have already run up in anticipation of an earnings recovery. So when the actual recovery will kick in, markets would say, look, we knew this was coming.
True. I think that would be absolutely true if you see a very short earnings recovery. Of course, there will be commentators who will say that earnings recovery will not happen. So there is still an element of doubt. Then there are commentators who will say something on the lines which you just said, is that it's priced in, and therefore it is already up, you are paying for it. And there would be another view, is that we are on a slightly longer term trajectory of strong earnings growth, which is where we would be, and that's why we would see every opportunity and every dip in the market as an opportunity to buy. It doesn't mean that go out and buy anything. It doesn't mean go out and buy the broad market without looking at your numbers and valuation. It only means be selective and be focused on India domestic story. The market still pays a premium for high quality names. Every disappointment is also punished there. So clearly there has to be some due diligence made on the business model and where they are. But if you look at the numbers which are getting reported, even such a large stock as Hindustan Unilever reported better top line growth than most people would have projected. Clearly, the fact that demonetization is not even now being discussed, and that it happened less than 4 months ago, means that the economic recovery has been much stronger than most people expected in December, January. So I think we are in a strong phase which will continue for maybe another 3 to 5 years. And in that context, the market definitely is not expensive. But also the widening of sectors will also happen. We like some of the capex names also coming through. So that is all something which is definitely going to help.
So in absolute terms, I mean, if you have to really, let's say, talk about the levels now. Where do you think this market could be a year from now? Do you think we should expect a compounding return of about 10 to 15%? Is that a reasonable estimate, or I would be a bull if I talk about a 15% return in next 1 year?
I would have a base case. I would have a base case compounding of at least 10%, and that's where the earnings trajectory should be. It could be even higher than that, depending upon what happens in the global environment. But 10 to 12% compounding from here onwards for the next 3 to 5 years is a safe assumption.
When you say you're bullish on the domestic recovery, which end of the domestic recovery are you bullish on? Are you bullish more on consumption, less on industrial, or are you bullish on more on industrial and less on consumption?
We are bullish on domestic consumption. We are bullish on the domestic capex cycle picking up. Incrementally, it will be first fed by the higher government spending both at the central and the state level, but it will eventually quickly broaden out. By 2019, it should broaden out to major industrial capex also coming in selected sectors. We have seen some announcements of capex coming in steel. That's one sector which has actually bounced back very strongly in the last 12 months. We would expect some of that to continue to pick up. So capex would also come through, but all capex and all consumption would be the domestic consumption cycle driving that. It's not going to be a V-shaped recovery, but it's clearly been a recovery where the gradient of the growth is going to go step up. And this is something which will primarily find itself in autos and in banks initially, and then broaden itself across sectors focused on India.
You know, the trend and flavor of this bull market, Sandeep, has been that the underperformers have really risen. We've seen that already play out with real estate as well as metals, the most under-owned, beaten down names. How do you approach the laggards of the recent past? That's IT and pharmaceuticals. And is it time at all to start bottom fishing there, or would you still, mind the gap?
I would still be cautious of export sectors. I think IT sector is seeing not only stronger rupee, not only policy uncertainty for the major markets such as the US, but is also essentially coming down to a much lower growth plane and valuation than it has historically been. I would stay away from IT right now. It would probably be something which I will evaluate after August, September. But right now we would still remain underweight. And similarly for pharma, we are probably going through a consolidation phase, and a lot of regulatory headwinds which the sector is facing will continue through most of this year. So I would evaluate those sectors post September.
I'm going to throw, talk about the entire global connection right now. Right now things are looking cozy. Global markets are at a record high. Indian markets, which had underperformed global markets for 15 and 16, are now simply catching up. In event of any global liquidity event, what happens to our market? Because the common answer which I get from everyone when I ask them why markets are going up, and the common answer is, Nikunj, there is too much of liquidity and that is the reason why markets are going up. In case of a risk-off moment, what happens to us?
So a risk-off event driven by external factors is an opportunity to buy. Categorically, India's growth rates are going to be strong. Yes, liquidity is propelling the markets upwards, and it does so in every bull market. Liquidity is, is fundamental to any rally. But is this just a liquidity-driven rally? I think if you ask that question and rephrase it, is India's rally just a liquidity-driven rally? I think you will get a much more graded and a much more layered answer. My view here is that yes, liquidity is essential, and if it comes off, then in fact it will be a good opportunity to buy, because a lot of strong domestic names which are actually now going to step up in terms of earnings growth will be available cheaper. So I don't think the fundamental and the structural drivers which have been put in place in the last 12 to 24 months are going away in a hurry. We took a lot of time. We have had years and we have sweated while earnings growth did not come through, and now that the building blocks are in place, the train is started to move away from the station. It's time to board the train and continue this investment journey rather than keep questioning whether anything is going to happen. So yes, a liquidity event can happen. Yes, it will take the markets down, but it will be an opportunity to invest.